What's going on here? Why are stocks flying high today when we have a situation where it looked like bad news came out? Okay, so let me explain this and kind of get into this in detail here. Alrighty, so first up, the reason stocks are going up is treasuries are going down, okay, especially on the long end, which is kind of, let's just think about it here. These are all going down here today. And the market's been pretty simple recently. If treasuries, or especially the long end, if treasuries are going down, then stocks are going up, and vice versa. If the long end's going up, stocks are going down. It's been a pretty simple market here recently. But where this gets really fascinating, right, is treasury yields drop after new data shows consumer confidence waning, right? I mean, if consumer confidence is waning, you would automatically assume, well, shoot, man, that must mean recession risk goes up. That must mean, a company earnings going to be as strong. It would usually cause the market to go down and be worried, right? The conference board said its consumer confidence index came out at 106. That was below the Dow Jones estimate of 116. So we're not talking about a small miss. We're talking about a massive, monumental miss in consumer confidence from this particular index, right? The conference board also said average inflation expectations increase for the next 12 months, which is really from like the consumer level. That doesn't mean it's from the Wall Street level. This is more from the consumer level, okay? Pressuring overall confidence, while the short-term outlook for income, business, and labor market conditions declined, okay? So basically people are expecting the short-term outlook for their income, their business, if they own one, and labor market conditions to decline. Traders also poured through new data on U.S. job openings. The latest job openings and labor turnover survey showed open listings declined to 8.8 million from 9.5 million. They also reached their lowest level since March 2021. Okay, so now it looks like we're starting to see some weakness in the jobs market, right? Now this is fascinating because in most markets, like you would think, okay, this is like potential bad news. Like, why would stocks be flying in the face of this situation, right? Well, normal market, bad economic news equals the market down, right? And good economic news makes the market go up. And this is most of the market. I mean, certainly the first several years of me getting in the stock market, this was definitely how the market approached things, right? Because, I mean, I got started in 08 and into 09, right? And at that time, it was just seemed like bad economic news on bad economic news. And then when we started like bottom out things a little bit and it looked like we were getting some glimmers of hope, the market would go up on these like glimmers of hope of like things are going to get a little better, and it looks like we're going to see stabilization in the banking system and see stabilization in the unemployment rate and those sorts of things, and we're kind of bottoming out, and we should slowly start to get better, right? But this is so opposite of the market we're in right now. We're in what's called a high inflation market. In a high inflation market, it's complete opposite. If you get really good economic news, the market's going down, because the thought process is, if the economy is too strong, really good, right? Well, that means we haven't killed down inflation. If you haven't killed down inflation, that means Fed funds futures and Fed funds rates are going to go higher. If those go higher, it's going to affect all the treasuries. It's going to affect all interest rates in general, which means car loans are going to get higher, which means mortgage rates are going to go higher. The whole dang thing's going to go higher, which means you're likely setting yourself up for a deeper, darker, potential hard landing type recession scenario the more and more you push interest rates. The more you push interest rates higher, the more you're likely going to have systemic problems in the banking system, the more likely you're likely going to have a credit crunch, and the more likely you're going to have a devastated economy at some point down the road when those Fed lags catch up, right? So we're in just a complete opposite market right now where it doesn't want this situation, right? Tesla, is my number 2 best stock overall. We're up $355,000 on this one, up 904%. And do keep in mind, I've taken most of the profits over time in good old Tesla mass. So this is what I got left. 1,665 shares of Tesla. Now, in regards to Tesla, right, let's call it what it is. They're in a real tough spot right now, not because of anything they've done. Their products are phenomenal, demand for days for the 3, the Y, Cybertruck, but interest rates have gone to the moon, just to be quite frank, over the last 18 months. We haven't had a deal with interest rates like we're dealing with right now in decades, right? It's been a long time. And so naturally, it hurts substantially home sales. It hurts substantially car sales. anything expensive, furniture sales, all that stuff gets hit hard, right? And so Tesla's in a bit of a price war right now. They're eating their competition's lunch, to put it quite frankly. They're eating their competition's lunch right now, and they're doing phenomenal. But with that being said, they're basically got one hand tied behind their back, which is interest rates. And so they're fighting with one hand, and they're destroying their competition still. But it would be a lot better if they had this other hand untied, and it's not the way it is right now, and it might not be like that for a while. And you can say, well, even if the Fed switches, interest rates start to come down, maybe that's because the economy got hit. Well, if the economy got hit and we had a recession, that would also be bad for Tesla as well. So that's where Tesla's just in a pickle in the short term, man. And when I say pickle in the short term, I'm talking really over the next 1 to 2 years, continues to be in a pickle. We know Cybertruck's coming. It's going to be very exciting for demand. But at the end of the day, man, the company's just in a tough spot here in the short term. Now, in regards to gold Tesla, we're looking at about a $750 billion market cap on this stock as of right now, right? This is my base case for Tesla. I have them knocking out about 32% revenue growth on average over the next several years, and I have them doing about that growth on the bottom line as well over the next several years. Obviously, years like this will not be as exciting. Some years, they'll be posting a lot better numbers, right? But this is I do it over an average over the years. So I think a 30 PE on this stock is pretty dang fair for 2027, because obviously Tesla will still have growth in 2027 and beyond, but it's not going to be the sort of growth you're going to see over the next, let's call it 2024, 2025, 2026. So I think a $1.5 billion market cap is pretty realistic for Tesla in 2027. And that's a double up from here, folks. That's a double up from here. So Tesla actually still is a buy, believe it or not, even after its massive move over the years. So that's good old Tesla for you. But once again, they're in a tough place in the very short term here. So you gotta take this baby apart from what's going on short term versus what's going on long term for the good old Tesla. Okay. Now, my number one best stock overall, this is a very confusing one, is ELF on a shelf. We're up nearly 1,300%, and unfortunately, I used to hold almost 10,000 shares of ELF between all my different accounts. Now I only hold 1,000 shares. I wish I held every share of ELF. Okay. Stock's done tremendous. A lot of people are like, "Is this an overvalued stock?" Well, I don't know about that, to be quite frank. It actually might still be a good value. Check this out. So, company trades in terms of this year's numbers at a PE of about 50. Now, you might say, "Gosh, that looks so high." Market trades at 20, something around there, right? Well, what if I told you this is a company that quarter in and quarter out kills numbers? Look at this. This is over the last several years of ELF on a shelf. They beat. They surprise the upside quarter in and quarter out. So whatever you think you're paying for the stock is actually much likely a much lower number, as been consistent for years with this company. They never freaking miss on revenue. It's ridiculous. For years, they just beat and beat and beat. Someday I'm sure they're going to miss, but I don't know when it's going to be. It's insanity, right? Check this out. EPS. Over the last several years, they missed one time. That was in December 2021 quarter. That's crazy. What are we talking about here? One miss in all these massive beats. And look at it's not just they're beating numbers. Look at the EPS beats. 92% upside surprise, a 113% upside surprise, a 105% upside surprise, a 126% upside surprise. So ELF on a Shelf is just arguably one of the best, most well-run companies in all of the world. And it's what are you willing to pay for a premium valuation for one of the fastest growth companies you'll find certainly in their industry, and one of the most well-run companies, period, in the entire world? I don't know a company that's more well-run than ELF. I don't. And that includes Tesla. That includes Meta. That includes Apple, Microsoft. There's no one in the world more well-run than ELF on a Shelf. That's a special stock. Not even NVIDIA is as well-run as ELF. Crazy, man. And so at the end of the day, I continue to hold those ELF shares, and I'll continue to hold those because I love that baby. So